Joining us now, Bob Elliott from Unlimited and Brooke May from Evans May Wealth. Guys, welcome. Bob, what's your assessment of how the market digested this jobs report with the 10-year higher, but the major indices also higher, led by energy and tech?
Well, I think we're back to the environment of higher for longer that we saw over the summer and in early 2023 here, where the job market remains relatively strong. There's no good reason why the Fed needs to proactively ease monetary policy in this environment. And that is particularly bad for the bond market because there are still 5 to 6 cuts priced in for 2024. So bad for bonds, good for stocks because growth continues, fueled by those wage gains of strong employment, and the combination of which is, in many ways, just continuing the type of dynamics that we've seen higher for longer for a long time now.
You say good for stocks. Brooke May, you think potentially very good for stocks. You think the S&P 500 could rise as much as 17% next year? How?
We do. Our price target on the S&P is 5,200 to 5,400 for 2024. Right now, consensus earnings growth is up about 11% from this year to next year. But if you look at Q3 earnings announcements, companies came out and while revenues were mixed, margins stayed strong. And we think that's because they had 2 years to adjust for higher interest rates. And we think that that'll translate into a good market next year, and we could see additional earnings surprises to the upside.
So then, Bob, why should people diversify here? Things might shift?
Well, I think the question is, how long can the stock rally continue before it pushes the Fed to have to do more? And so that's why when I talk about this sort of higher for longer environment, it's generally bad for asset prices in aggregate because we've got to get more tightening in order to slow this economy, given how hot the labor market is and how wage growth continues to be above what's appropriate for the Fed to meet its target. So that's not necessarily a great long-term bet on stocks, even though in the short term, stocks outperform bonds. It's once we get that tightening that we'll probably start to see stocks roll over maybe in the first, at the end of the first quarter or the second quarter of next year, given the dynamics.
Speaking of tech and financials, Brooke, you like Charles Schwab and ServiceNow. Why?
Schwab just completed the merger with TD Ameritrade, so there are going to be some cost synergies there. And when you look at Schwab, it's nowhere near a new 52-week high like some other stocks are. It's down 23% year to date. So when we look at the earnings growth projection of 20% from this year to next year and those cost synergies, they're going to contribute to earnings. And once we see a positive slope in the yield curve, there's going to be a contribution there from the net interest. In addition to that, when rates start to come down, people are going to move out of money markets and into traditional investments, and that'll bode well for Schwab and their earnings.
All right, interesting.
We also like ServiceNow. Oh, sorry,
go
ahead.
Go ahead.
We also like ServiceNow. We added it to the portfolio a few weeks ago. They're a software company that focuses on workflow processing. And initially, they were focused on IT tickets. But since then, through improved programming, they've expanded their offering to HR and sales. So we think that their addressable market has grown significantly, and their earnings are expected to be up 38% from this year to next year, and then an average of 27% per year over the next 5 years. So we think that there's quite a bit of exciting news going on there. They've adopted generative AI, and they announced in their third quarter call that they have had several multi-million-dollar deals in that space. So there's a lot to be excited about.